Hello and welcome to our second video lecture for week 9, chapter 11, Project Analysis and Evaluation. A couple of topics in this chapter we're going to cover very briefly. We're going to look at evaluating net present value estimates, look at scenario and other what-if analyses. We'll take a brief look at break-even analysis, and then look at operating cash flow, sales volume, and break-even, and something called operating leverage, as well as capital rationing. So if we want to look at evaluating net present value estimates, what criteria do we use? Remember that the future cash inflows for a net present value computation are just an estimate. A positive net present value is a good start, but we need to really take a closer look at those cash flows. The forecasting risk is how sensitive our NPV is to changes in the cash flow. So the more sensitive, the greater the forecasting risk. In other words, the more if small changes in cash flows result in large changes in net present value, then we are at a high risk situation. Also, then we need to look at sources of value. Why does this project create value? The way we can do this is to look at scenario and other what-if type analysis. Scenario analysis is something that we can use to assess what happens to the net present value under different cash flow scenarios. So generally, we take a look at, there's actually three, the best case, worst case, and base case. But the best case is high revenues, low costs. Worst case is low revenues, high costs. And then we measure the range of possible outcomes in between these two. The best case and worst case are not necessarily probable, but they can still be possible. So they give us under our scenarios. So if we consider the following project where the initial cost is $200,000, project has a 5-year life, there's no salvage, depreciation is straight line, required return is 12%, the tax rate 34%. The base case NPV under these conditions is $15,500. But if we start varying these details, we look at the worst case with a negative net income and low cash flow, we see a negative net present value and a negative IRR. And then the best case, we see high net income and high cash flow with a high net present value and a high IRR. So we need to use scenario analysis to sort of bound our assessments of where this project will take us. Sensitivity analysis is when we change one variable at a time in our financial assessments, and we look at the changes on net present value. So it's really a subset of scenario analysis. So scenario analysis looks at varying everything, best case, worst case, then base case. But then in sensitivity analysis, we look at one specific variable, and we change that, and we see what effect that has on net present value. So the greater the volatility in net present value in relation to a specific variable, the larger the forecasting risk associated with that variable, and the more attention we want to pay to its estimation. So the risky variables are the ones that have the greatest impact on net present value. The simulation analysis, we're not really going to do any of these, but it's just really an expanded sensitivity and scenario analysis. Monte Carlo simulation, you can buy software for this. It can estimate thousands of possible outcomes based on conditional probabilities and constraints for each of the variables. This is actually a branch of operations research. Somebody tells you they're running a Monte Carlo simulation. They're probably using advanced software. It might be interesting for you to look at it. I wouldn't expect you to know how to do it. Just know what it is. The output of a Monte Carlo simulation is a probability distribution for net present value with an estimate of the probability of attaining a positive net present value. This is very important. But remember that the simulation only works as well as the information that's entered. And very bad decisions can be made if care is not taken to analyze the interaction between variables. So, making a decision. At some point, we have to stop all the analysis and we have to make a decision. We have to be aware of paralysis by analysis, going back, looking at more figures, making more assumptions. At some point, we just have to cut it and say, we're going to decide based on what we have. So at some point, Here are some good rules of thumb. If the majority of your scenarios have positive net present values, then you can feel reasonably comfortable about accepting the project. If you have a crucial variable that leads to a negative net present value with a small change in the estimates, then you may want to forego the project because the project will have too high a risk. This is where the sensitivity analysis comes in. So if you've got a lot of positive net present values, it's probably okay. But if you've got one variable that small changes result in huge changes in net present value, especially driving it negative, you may want to reconsider and forego it. Break-even analysis is another method for looking at project assessment. It's a common tool for analyzing the relationship between sales volume and profitability. There's three common break-even measures. Accounting break-even, which is the sales volume at which net income equals zero. The cash break-even, sales volume at which operating cash flow equals zero. And the financial break-even, which is the sales volume at which net present value equals zero. So it's very important when you get involved in break-even analysis to specify which one of these break-even measures is being used, because they give very different results depending on what you're looking for, and each one is appropriate in different situations. And you may want to actually run all three and assess the difference in the results that you get. There are two types of costs that are important in break-even, variable and fixed. The total variable cost equal to quantity times the variable cost per unit. So you've got a variable cost per unit of 10 cents and you have 100, you've got $10 in variable costs, and they go, if you've got 200, it's $20, so they are constant per unit. Fixed costs are constant overall, regardless of output over some time period. These are things like the repayment repayment on a loan, or paying coupons on a bond, that kind of thing. The total costs for any given level of production are fixed costs plus the variable cost times the quantity, the cost. So if your firm pays $3,000 a month in fixed costs, let's say rent for a particular facility, you also pay $15 per unit to produce your product. What's your total cost if you produce 1,000 units or 5,000? If you produce 1,000, your total costs are 18,000. If you produce 5,000, your total costs are 78,000. So the average cost is another important figure. The average cost is the total cost divided by the number of units, and this will decrease as the number of units increases. But the marginal cost is important to look at. It's the cost to produce one more unit, same as the variable cost per unit. So let's take an example. What's the average cost and marginal cost under each situation in the previous example? If you produce 1,000 units, your average is 18, but your marginal is 16. If you produce 5,000 units, your average is $15.60, but your marginal is $16. So your average is dropping, but your marginal cost is still $16. Again, there's three types of break-even analysis. Your accounting break-even is where net income equals zero. Your cash break-even is where operating cash flows equals zero. And your financial break-even is where net present value equals zero. When we run these figures, we see that cash break-even is always less than accounting break-even, which is always less than financial break-even. So you really need to run all three to get a good idea of where a particular project is going to break even. We have a concept here called operating leverage. This is not really that big a deal. We'll spend a few minutes with it. Leverage in finance is just like physics, where a small change in one thing produces a large change in another. And in finance, effects of leverage are similar. When we move the balance point away from the center, away from the small changes on the left equal large changes on the right. And so we're concerned with small changes in variables that are affecting large changes in other related variables. Operating leverage is the relationship between sales and operating cash flow. And at different amounts of output, small changes in sales can yield a large change in operating cash flow depending on the degree. The degree of operating leverage measures the relationship between sales and operating cash flow. And so the higher the degree of leverage, the greater the variability in operating cash flow. and the higher the fixed costs, the higher the degree of operating leverage. And the degree of operating leverage depends on the sales level you're starting from and what your revenues are at that particular sales level. So if sales are 300 units, this meets all three break-even measures in the previous example. What's the degree of operating leverage at the sales level? So operating cash flow is calculated as 2 million. The degree of operating leverage then is 1 plus 1 million over 2 million, or 1.5. So we would expect to see 1.5 unit changes in operating cash flow as we change. So what will happen to operating cash flow if unit sales increase by 20%? The percentage change in operating cash flow is simply the degree of operating leverage times percentage change in quantity, 1.5 times 2, or a 30% change, a 30% increase in operating cash flow. So we see that the operating cash flow increase is not linear in proportion to the unit sales increase. And this is important for understanding whether or not we're going to increase unit sales on our sales projections, whether or not we would want to undertake such a. Finally, capital rationing. Capital is a relatively intuitive concept. It happens all the time when a firm or division has limited resources. We have something called soft rationing, which is limited resources are temporary. Maybe it's just a downturn, waiting for another contract to come in. Sometimes they're self-imposed. But hard rationing is the capital will never be available for this particular. So the profitability index is a useful tool when a manager is faced with soft rationing to help select the best project for a firm at that time, which is the most profitable. So the most important topics of this chapter. It's important for you to recognize that future cash flow estimates are uncertain, so we do our best to reduce that uncertainty by using standardized methods for calculating them. Scenario sensitivity and simulation analyses focus on the risk of the uncertainty of cash flows. Even though we've done our best to make sure that they're accurate, that we assess the effect of changes in those cash flows on things such as net income and balance sheet numbers. Break-even analysis looks at the relationship between sales volume and profitability, and what is the required level of production, required level of activity to break even where we start becoming profitable. Operating leverage compares fixed costs and variable costs with respect to operating cash flows and looks at the changes that can be expected in operating cash flows as a result of changes in output. And finally, capital rationing recognizes that economic times often dictate availability of funding for even worthy capital projects. So it helps us to do a profitability analysis and do a profitability index on various projects so we can see which would have the greatest return. So if you have any questions, please post them in the Q&A thread. Otherwise, we will see you in the class shell.